Hi, welcome to Ilanomics. We are again going live this week with this episode of our weekly show. And before we start this show, I would like to highlight something that is very critical to the good journalism we are striving to do, and that is your support. Many thousands of you have contributed and taken subscriptions to the print. It is critical you do so because we need your support in these very tough economic times and need to keep getting subscription to keep carrying on the good work we have been trying to do and for which you people have come and supported us. So if you have not taken a subscription, please do so at the earliest because we need that to keep continuing and maintain the momentum of the journalism we are doing. There are options for monthly subscriptions, annual one-time subscriptions, and both for people in India and outside. So please do visit theprint.in/subscriptions and pay for what you read and watch at theprint.in because you are extremely valuable readers for us. This week, we are doing this show live also because it's a very important but also very technical subject. We are talking about capital controls, and this is something which Professor Ila Patnaik will elaborate on. But you would be surprised to know that the IMF, the International Monetary Fund, has taken India or the Indian style of doing capital controls as a model and recommended that other countries should do this. When was the last time an Indian model was touted as something that rest of the world should follow? That should get us going here. Uh, so Ila, I mean, like I was telling you before we started, talking on the show, can you do a very basic explanation of what are capital controls?
Uh, c- Capital controls are controls on uh, cross-border flows, financial flows that occur for buying or selling assets. Now, there are two kinds. India for the sale or purchase of financial assets. It could be FDI, it could be debt, it could be portfolio investment, that's equity, when foreigners buy shares of companies. Very often there are companies that invest in startups. Very often, there are we often hear the words private equity funds or angel investors or investors who come in and put money into companies that are just starting. So it could be of various kinds, but primarily what it gets for you when you put that money into India, or when an Indian puts that money abroad, is not a good or a service which is part of the current account, which is, like buying something right then and there, but it buys you an asset that can give you returns, an asset that can be later bought and sold in uh, that country. Sorry, I think we lost the link. So there could be many reasons why a government may want to put controls. Those are called capital controls.
And this year, which has been a very unusual and economically catastrophic year, saw a lot of fund flows away from India in the beginning of the pandemic because there was a lot of selling. Foreign investors sold and took funds out of India. But there has also been inflows after that, after the initial outflows for the first couple of months. How do
Yes.
you explain that, very unusual kind of a phenomenon, Ila?
So, in the period from March to May, there was a very high uncertainty in the global economic environment. India also had imposed a very tight lockdown. In the face of global uncertainty, usually what happens is that foreign investors want to take less risk. When they want to reduce the risk that they take, then they move away from emerging economies like India to countries like the US, because that they believe is less risky. One of the reasons it's less risky is because when they do their accounting, they do it in dollar terms. And so if there are currency fluctuations, so the exchange rates move up or down, which emerging economy exchange rates might often do, especially in a crisis, then accounting in dollars is always risky because you're taking currency exposure on your balance sheet. So what they try to do is, one, partly for that reason, and partly for the reason of their belief that the US government will be able to return debt, that it will be able to keep the dollar afloat. So there is what is often known as risk on, risk off that happens. And in periods of high global uncertainty, there is a risk off. And capital flows out of emerging economies and back to countries like the US or other developed countries. Part of the capital flow that happened from the March, March, April, May was where almost the whole world was realizing that there is a pandemic, that it is spreading, that the pandemic is going to affect economies all over the world, that it is going to affect the fisc, it's going to affect balance of payments, a lot of things. And in this face of that high global uncertainty, what you saw was capital flowing out of India. Later, as the uncertainty went down, countries started opening up. And very importantly, as advanced economies started pumping liquidity, doing fiscal stimulus, monetary and fiscal stimulus into their economies, at that time, uh, there was this feeling that, okay, we can take risk now. So we moved from that risk off to the risk on situation, and money came back in. So when there's a lot of global global liquidity, we've seen that in the past as well, that money flows into emerging economies. So when earlier, after the global financial crisis, there had been quantitative easing by the US government and by UK and so on, that time again we had seen that money, lot of dollar flows, foreign capital flows came into emerging economies. Similarly, now also after June or so, so from July, August onwards, we started seeing money come back in into the Indian economy as well, foreign capital come back in.
Mhm. And this inflow, Ila, has an impact on our currency, on our economy. And the RBI plays a role there when it sort of tries to regulate these flows. And you talk about that in your column this week on the print. I request our viewers to go to the print.in and read the column which has these details. What role does the RBI play in regulating, and why does it need to play that role?
So very often, what a central bank tries to do is to not manage the level of the currency, but to manage its volatility. So when the RBI sees that the rupee is very volatile, then very often they try to step in so as to make it less volatile, so that it's not that in the morning it is 70 and in the afternoon it is 75 and then goes back to 65 in the evening. So it tries to manage its volatility. Often that is something that the RBI tries to do. Some central banks might try to fix the level of the currency. By fixing the level, it's not fixing it administratively, but what is often in the literature called pegging the exchange rate. By pegging the exchange rate, I mean that they step in to buy and sell dollars depending on the demand and supply conditions in the economy, in the forex market. And by buying and selling dollars, they try to stabilize its value. If there's too much demand and the value is going up, then they'll come in and increase the supply, so sell rupees, and that would stabilize the rupee. Now, what we see in a period when, say, there's too much capital flowing in, like we saw earlier this year, then the RBI, might also attempt to prevent appreciation. So there are some things that are achieved by preventing appreciation. There are some things that are achieved by preventing depreciation. So depending on which lobbies are stronger, what the politics is, what the government wants, what the RBI tries to do is to, take one stand. If there's a lot of dollar inflow and it feels that, oh, this is going to make our exports uncompetitive, then it might try to step in and might try to prevent an appreciation of the rupee, because when the rupee gets stronger, your exports become more expensive and you become uncompetitive. Alternatively, if there is high domestic inflation, then the central bank may feel that, oh, the rupee is appreciating, but that's actually good for me because it's going to make imported inflation low. So when the currency is stronger, then I buy things from abroad cheaper. And by reducing the amount of inflation that I'm importing, it is then able to control prices and bring inflation down. So there can be various reasons why. I mean, we can go on. There are reasons why it may prevent a depreciation if a lot of companies have borrowed in dollars. So then the RBI would worry, or a central bank would worry, oh, this could create a systemic crisis because they've all borrowed in dollars. And now if the rupee crashes and they have to return the money that they have borrowed in dollars, then they won't have the money to return. So there can be various reasons why, a central bank might want to interfere.
Ila, many of our viewers are asking us for you to explain capital controls again, because there was a small technical lag and we apologize for that. Many viewers missed what you were explaining about capital controls. Can you do that very briefly again, please?
Absolutely. So my explanation starts with differentiating between the current account and the capital account. We need to do that because otherwise we don't understand the concept of capital controls. We are required as members of the IMF and our own commitments, we have a fully open current account, which means that to buy and sell goods and services, any foreigner can buy, I can export, you can import. I mean, it's just completely free. There are no restrictions on the current account. RBI has some administrative restrictions on how much cash you can take out in dollar terms. So, $2,500 or $3,000. But if I was to do the rest in, say, through a travel card or some other means, there are no restrictions. Okay, any amount of money can be brought into the country or taken out of the country as long as it is for the sale or purchase of goods or services. The other account is the capital account. The capital account accounts for those cross-border flows that happen for sale and purchase of assets. So if a foreigner is buying an Indian company, shares in a company, giving debt, then that comes in the capital account. Similarly, if an Indian wants to take money abroad to buy financial assets, I want to buy shares of Google, say, or I want to buy a house in London, or I want to give a loan to somebody abroad, that all comes under the capital account. And capital controls are those controls that are imposed on cross-border transactions for the capital account.
Perfect. Thanks for that, Ila. So there is an Indian model. What is that Indian model? The central bank, the RBI, has been following, and why has the IMF or the IMF evaluators, why have they found it a model worth emulating?
So the Indian, let's first go into the Indian model, and I
Indian
would say
model.
that they have not exactly said that people should follow the Indian model, but some of the features of the Indian model.
Yeah. Okay.
So the Indian model has been that we actually never removed our controls. So we have multiple agencies. We have regulators such as the central bank, SEBI, IRDA, the insurance regulator, PFRDA, the pensions regulator. Each one of them would say, okay, you can only do this much or that much, or buy so much of an insurance company. So they all put in their own regulations. There are also various regulations such as how much can an NRI buy, how much can a foreigner non-NRI buy, so how much can a mutual fund buy abroad or inside the country, how much can a bank do. So we, according to the instrument, according to the person who's buying or selling, and according to what is being bought or sold, we have a lot of rules and regulations. There was a committee set up headed by the SEBI chairperson, which looked into the rationalization of capital controls. And we have in that, there is a discussion on how India compares with the rest of the world. And it is one of the most complex capital controls anywhere in the world. So while on the one hand, it might seem that FEMA, earlier there used to be a FERA, now there is a FEMA, that's the law which regulates these. It might seem that these come under FEMA, but actually when you look even into the acts of the various regulators, the financial sector regulators, you'll find that there is something that allows them also to do some capital controls. The two features of the Indian capital controls, which are, I think, in the present context, which are important, are one, that they are long-standing, that it's not that we put controls when there is trouble. The controls are always there. And second, that they are preemptive. It is not that when one has trouble of any kind, maybe a very sharp outflow or a very sharp inflow, a sudden stop or a surge, as we call them, it's not that the controls have to be put in only then. So the long-standing nature and the fact that they are preemptive is something that recently the evaluation office of the IMF, which was looking at a new framework under which from 2012 onwards, the IMF has been allowing countries or not disapproving of countries doing capital controls. In its evaluation, the IEO, the evaluation office, has said that you could look at, you perhaps should recommend also bringing into your framework. So, they are evaluating the IMF. So what they're advising is the IMF, not countries. The IEO says you could bring in long-term capital controls and you could allow preemptive capital controls. So in that sense, this is very close to the Indian model.
Fantastic. Ila, we have viewers sending us questions, and let's start taking some questions. I would like to thank the viewers who have been patiently waiting for their questions to be asked. And we have this question from Tarush on Twitter. Tarush is a regular viewer of Ilanomics, and thanks, Tarush. Tarush is asking, Ila, why don't the RBI print some currency? As our forex is quite good, we can take a rating downgrade and even a currency can stabilize.
So RBI has been printing currency, but you do realize that so when it buys up dollars, the 3 months that we spoke about, March, April, May, when its forex reserves went up, actually back to back, when forex reserves go up, RBI prints currency. Okay, because if you're a student of economics, you would know that reserve money is net domestic assets and net foreign assets of held with the RBI. And when money was flowing in, then they were printing currency. To some extent, if there was too much liquidity in the market, if there was fear of inflation, or there wasn't enough borrowing happening, so it was in the midst of a lockdown, there wasn't a lot of credit offtake, and if it was felt that we are actually printing more than the economy needs, then, or the economy is producing. So, if money is running far ahead of output, then RBI does open market operations. Through its open market operations, it buys back the currency that it has printed. So in the present context, I would say that they have been doing that.
Thanks, Ila. Arjun on Twitter has asked us, what is your view on the Modi government's protectionist policies and taking India back to the 1970s and 80s by banning imports like imports of air conditioners, toys, and his ministers talking about import substitution? I know it's not related directly to what we are talking, but again, this involves capital flows.
No, these are not capital flows, these are current account flows. But nevertheless, uh, okay, so I could.
Protectionism also, there is a certain protectionism which is coming into, say, preventing China from investing in Indian
Absolutely,
companies.
absolutely.
So there is
So
some amount of
yeah,
capital control there.
one can always take a very purist position and say that protectionism is always bad, okay, and that free trade is always good. I think the difficulty today that many countries, and not just us, many countries are facing is that what do you do when there's a growth of a monopolist like China, and whether there are increasing returns to scale, as we are seeing in a lot of products today, and that China is becoming pretty much a monopolist in many of these. And once your domestic industry dies, then what do you do? So I would say my answer would be that what India needs is to strengthen her own infrastructure, is to make it easy for businesses to produce, is to reduce tax rates within India, is to get the power sector to work through reforms in power distribution, is to reduce bureaucracy, is to improve rule of law, public safety of life and property, and we improve our environment and become more competitive rather than impose controls. My suspicion is that since that's not easy, and that's not something that can be done like that, the easy path that governments choose, whether it's ours, whether it's Trump, whether it's one way or the other. Europe puts phytosanitary standards, so many people do many things. Okay, I think that they choose that easy way out, because becoming competitive in the face of the Chinese manufacturing superpower that it is, they are afraid that their industry, their employment is suffering and that it's dying out. And of course, we would all want the harder path to be chosen, the correct path to be chosen, and to become more competitive. Whether, what happens is that you raise tariffs, you put bans, and you also don't solve this. So then you'll not actually achieve anything out of it. But if you were to just buy time and try to address these issues as soon as you can, then in principle, it could be productive. It could be useful.
Mhm, mhm. Kunal Kamal has a similar related question. Ila, thanks, Kunal. Uh, he says we are talking about Atmanirbhar Bharat. We want to sell our products around the world, but we are not allowing foreign products, or we don't want to allow because products are still coming in. Won't this hurt India's growth?
So, very much, if you want to be part of global supply chains, then, which is what India has said it would like to be, then it would be a very contradictory signal to say that we are not going to allow imports, because global supply chains, by definition, means that we would be importing something, adding some value, and then exporting it further ahead. So, it is not a sustainable strategy, I believe. And in fact, if we had for the last 30 years been addressing 40 years since, after 91, like many countries did, many countries around the world. I mean, you could talk about Korea, for example. What they did was to try and improve their own domestic environment along with trade liberalization. So while they did trade liberalization, they also focused on their own infrastructure, improving their domestic environment so that they could be self-reliant and Atmanirbhar. I think that's really what is trying to be achieved. But I think what we were not successful in doing that. We didn't do that, whether it was political economy reasons, lack of interest, vision. I don't know. There are many, many reasons why that wasn't done. And so today we are in this situation where there is this fear of China kind of destroying what toy industry and lamps and so many consumer products. And in that fear, the way the world is responding and the way the Indian government, the American government, the way governments are responding are to somehow that's also a lot very political. So to somehow try to block these off and gain. But I don't think that's a sustainable strategy at all.
Himanshu Borse has two related questions. The first one relates to disinvestment in public sector companies. He asks, would such disinvestment help bring in more Western capital into the country? And also, while India is trying to control the inflow of Chinese capital into India, will that gap be somehow compensated by capital from Western investors?
So I think the most important function that disinvestment serves is to improve allocation of resources within the country. It's not about foreign capital. So if 1,000 bright young men and women are working in, say, an engineering firm, we do have public sector engineering companies which are producing nothing. Okay, then that labor, that skilled labor, on whom not only is it that hundreds of crores are being spent, but who could have been productively employed, are not today productively employed. And what the country is losing out is what they could have contributed to GDP. So labor, land, capital, all of this is being unproductively used if it is in an enterprise that year after year after year is making losses. Now, other than the oil companies, oil refineries, and a handful of others, so it's not zero, but there's a handful of other public sector companies that are, doing well. But other than those, there are a large number of public sector companies which are loss-making year after year. So really what is happening? You have land, you have labor, you have capital, you combine them and actually the value is less than what it could have produced. So the main reason for disinvestment and the advantage that it brings to us is a reallocation of land, labor and capital of our resources so as to get higher output. It's not about bringing in foreign capital. So that's the point I want to make, that it's about better allocation of resources.
Fantastic. Ila, we have time for one last question, and this one is from Saurabh Raj. Saurabh says, don't you think we need improvement in investment, and that means we actually need to lose capital controls?
So if we had more time, I would have actually talked about how India has too much capital controls. There's too little transparency. There isn't enough rule of law. And you get all kinds of controls imposed in various ways. So the committee report I was talking about, the UK Sinha committee report of 2010, was talking about rationalizing capital controls. And not only is it, so there are two things. One is to reduce the controls, and the second is to rationalize them. And what was suggested was, first let us rationalize them. That is, you don't have these multiple controls, one on somebody, the NRI, there's something else on NRI, there's something else on a foreigner, something else if you come through mutual fund, something else if you come through debt fund, so not only do you rationalize them, so initially maybe you can just rationalize them, and second, you need to reduce them because India needs more capital. So that is why I was also saying that, in our article, Radhika Pandey and I have written about how, if the IEO is going to tell the IMF, so the IMF is going to review its framework next year. And if the evaluation office is telling the IMF to do long-term preemptive capital controls, it needs to look at what the initial conditions were, where are you coming from, and then it needs to focus on making them transparent and making them bringing rule of law into it. And that's really critical. You can't just have the India model where not only are our controls arbitrary, high, there's a jumble of them. We've been doing a lot of work on this, and if anybody's interested, I'll be happy to share our papers.
Fantastic. If you have any requests for papers, please do go to the comment section and message us, and we will respond and get back to you with the papers Ila talked about. Please do also read the column this week, published earlier in the day today on theprint.in. It's in Ilanomics, a special section we have there. Thanks for watching this one. We really appreciate your questions, and if you have any suggestions on what we should take up next week, please do message in the comment section, and we'll try our best to respond to your requests. And thanks for watching this week's Ilanomics. We will be back with another version next Friday.